No, thank you, Guillermo. Good morning, good afternoon, everyone. Want to thank you all for joining us today for this AMEA Agribusiness Market Ecosystem Alliance Environmental Working Group Dialogue Series. This will be our second webinar. We're really excited to have Dan Zook from ISF Advisors and Juan Taborda from Root Capital with us today. And for a little context, just to get the conversation going, the AMEA Environmental Working Group is part of the Agribusiness Market Ecosystem Alliance here in 2025, 2024. It was established with this kind of mandate. I'm not going to read through it because I want to save time for the presenters today, but just as a way to kind of introduce you if you're new to AMEA, to the work that's ongoing. I wanted to take a quick moment here at the beginning of the webinar to give you a little bit more background information. The working group itself is part of a broader global AMEA network of partners, as well as local networks of partners who focus on business development service provision to agri-SMEs and overall are committed to agri-SME professionalism. And so something that recently happened, and you can actually download the report, and the link is here for your future download after the presentation. We had our global convening in Tanzania earlier this year in October. And one of the key things that came out of this discussion was really thinking about development financing. Is it a crisis or opportunity? We talked a lot more about these new innovative blended financing models that are becoming more prevalent, but also have been around for some time, and how that may affect business development service delivery, and also the technical assistance that AMEA members are providing to farmers, to cooperative agribusinesses, to agri-SMEs, et cetera. So something you might find interesting later on. But as for today, we're going to be speaking about blended finance for climate-smart agribusinesses. And we're really going to hone in on the expertise that Dan and Juan bring on technical assistance, and really thinking about more the importance of technical assistance to the long-term change we want to see in various landscapes around the world, especially when it comes to global goals around climate finance, climate adaptation, climate mitigation, which is super timely right now with COP30 going on in Berlin, Brazil. And it's a really important topic. So I hope we'll be able to dig into some of that detail here later today. Lastly, I have this slide for your follow-up. If you have any questions about what BDS is, there's some key definitions here, as well as the 6 core capacities that the AMEA network aligns BDS services of its membership around, which is ISO 18716, which aims to empower farm organizations to develop defined business capacities to unlock growth, and the business capacities are there. Just wanted to provide some of that introduction. I'm not going to belabor those points today because what I want to do is pass it over to Dan Zook from ISF Advisors to take it away for the second AMEA environmental webinar. So Dan, with that, I'll pass it over to you.
Great, thanks, Casey. Glad to be here with you all. I'm going to do a sort of a quick overview of a report here that we did with CPI. It's a Blended Finance Playbook for Agri-Food Systems. And go to the next page, Casey. Just to briefly introduce, if you don't know ISF, we are a research and advisory company. We're very focused on mobilizing capital for more sustainable, resilient, inclusive food systems. And so over the years, we've published a lot. You can see some of our publications at the bottom there. But we act as a design catalyst. And so we've been involved in the creation and launch of a number of funds and facilities like the FOSSA fund of funds focused on agribusiness, and worked on nutritious food financing facility, first nutrition focused impact fund, and various other facilities. Done quite a bit of work with AMEA of late too, looking at business development services. Then you're probably all familiar with CPI. They are sort of the organization when it comes to tracking climate financing, and then the CLIC is specifically a group within CPI, or a coalition that includes investors focused on climate finance. And so we worked with them to do this piece. And the report was, next page, Casey. The report is largely focused on investors, but I will try to speak to particularly the TA side of these kinds of deals, because I know that's what this audience is most interested in. But when we did this research, the goal was basically to create a playbook. And I mean, there's a lot of different ways to invest in climate-smart agri-food. So we kind of try to boil it down to kind of 5 archetypes. And we reviewed all of the existing research we could find out there, did interviews with a a bunch of investors and other relevant stakeholders. And then we did case studies on 9 sort of initiatives, deals, funds, facilities that you can find profiled in the report. So it's a very like case study focused report because we want to try and get down into like, well, who's actually doing what, that's interesting in this space. So if you want to learn more about these cases, you can download the report. Next page. So I'll just jump right in. These are kind of the 5 plays that we defined in the report. So I'm going to walk you through these 5 plays, and then on the next page, I'll talk through some brief case studies of each to make it a little bit more tangible. So the first play is around aligning system goals. So basically doing like systems-based financing. And what we're thinking about here are kind of landscape-based projects where, we know that in order to address climate resiliency, it's never just like one deal, one investment that solves it. It's like a whole bunch of things have to come together. You need the technical assistance providers. You probably need government at the national and potentially local level involved. And so the opportunity here is around organizing systems-based investments around different kinds of investments. And I think, yeah, like I said, the classic is sort of landscape-based projects, project financing and in that kind of space. And I think there's a big role for TA providers because you need to start with, well, what is the government trying to achieve? What are the NDCs or the priorities of the government? And you want to build off of that in order to then develop a program. And there's probably some kind of NGO or donor funding around it as well. And then you're thinking about how do we bring financing into the system? How do we get root capital, Agri-3 or others into this system alongside around investable opportunities. So that's kind of the opportunity for TA providers. The second play here is thinking in terms of assets. So an investor typically invests in an asset of some sort. And the second play here is around thinking larger scale natural capital assets. Think mangroves, for example, or larger kind of infrastructure plays around climate or coastal resiliency. And so that asset is like, how do we think about the ecosystems and the services they provide? How do we think about the monetization or the businesses within that ecosystem, say tourism companies or others that are generating revenue based on the preservation of that asset. The third play here is around investing in climate-smart infrastructure and services. So another kind of asset from an investor point of view is like, what are some of the technologies or solutions? So maybe we're going to invest in distributed renewable energy. Maybe we're investing in irrigation, cold storage. There's all these different solutions, technology solutions that are needed in order to create more climate resiliency. And there's an opportunity for investors to create funds or facilities that invest in those assets. And I would say complementary on the TA side, there's an opportunity, and this is actually what the CLIC, the CPI has also that accelerator that is looking for different businesses that are creating solutions around climate resiliency and then helping them become more investable and then connecting them to investors. So I think that's an opportunity on the TA side is how do you help these technologies, these business models become more investable and connect them to the right kind of investors. The fourth play is around technical assistance. So here we go, sweet spot for AMEA. And specifically, it's how do we create TA facilities or TA offerings that complement what the investors are trying to do in this space. And I'll talk about that a bit more in a moment with some of the case studies. And then the final one is, well, how do we kind of incubate or scale local financial intermediaries? How do we unlock the financial system in a smart way with climate objectives so that they are financing the kinds of businesses that the AMEA network works with. Why don't I go to the case studies? Because I think that'll make it more tangible. So next page here. Okay, so first one, let's talk about the And Green Fund. So this is an example of sort of a systems-based approach to financing. What I like about And Green Fund is that most investors, they kind of try to create a portfolio around different opportunities that they see in the market. And Green starts with a climate analysis in a given geography. So they really like Indonesia and Brazil, but they're in a lot of other countries as well. And so they come into a particular jurisdiction and they start with a climate risk diagnostic and figure out, well, what are the biggest risks in this region? And then what are the businesses that are involved in these supply chains? And what are those businesses doing to address those risks? And then how can we finance those businesses to deploy these kinds of solutions? And they recognize that in order for businesses to do that, they often need longer term debt, because the banks are typically providing shorter term debt. So these are like large businesses that are not particularly capital constrained, but it's hard for them to get medium and long term debt in order to implement, say, a regenerative agriculture program with the farmers in their supply chain. So Anne Green comes in and provides that kind of subordinated financing on a longer term basis to help farmers do that. So, I think this, from a TA point of view, there's interesting opportunity for TA providers to like work with, Anne Green has its own TA facility, but to work with those kinds of providers to do the TA around those jurisdictions, or really just to even support the financing of the climate risk analysis in the first place. I know Juan will talk about this, but Root Capital has done really extensive, climate analysis around their value chains. But there's a lot of other value chains where that analysis is needed. The second case study here is the Blue Alliance, or Blended Finance Facility. And this is an example of those nature-based assets. So the Blue Alliance is focused on preserving, marine protected areas. And what they do is they have a bunch of partners involved in this, and they're looking at how they can use concessional capital, including grants and technical assistance, to support businesses that are creating positive externalities for these marine protected areas. So it could be sustainable processing of fish. It could be, tourism in those areas. Could be insurance. So they've got Howden, insurance provider involved as well, in order to bring in insurance to these models. The third case example is the Climate Investment Fund. This is through the World Bank, but it's actually it's a kind of a multi-donor financing program. It's channeling $11 billion of pledged concessional capital through the MDBs in order to support different kind of solutions, within the climate resilient space. And so it's a pooled kind of concessional fund. They're doing grants and concessional loans in order to crowd in investment to some of these emerging solutions around cold chain, irrigation, storage, and other kind of plays in this space. Okay, the fourth case study is the CASA program. This is a technical assistance facility. What I like about the CASA program, it's funded by FCDO, and I think a few other donors have come into it at this point. And it's kind of like a multi-investor TA facility. So the CASA program is partnered up with a whole bunch of investors, and it's trying to provide technical assistance that is going to complement these investors within climate resilient space. And they tend to double down on specific value chains in specific countries, and then work across those value chains to make them to work with the business to make them more investor ready. Another cool thing about the CASA program is they do a lot of kind of broader sector engagement. So they're trying to publish a lot about what they learn and share that with other investors and with other TA providers in order to create kind of this like public good in addition to technical assistance programs. And then finally, there's the FOSSA fund. This is an example of how we unlock the local financial system with kind of a climate resilient lens. There's the FOSSA fund, and there's like the ASELI facility is also another great example. The FOSSA fund, we worked on it ourselves. It was with the Norwegians and USAID, and initially got $70 million, 35 each from Norwegian government and USAID. It was all grant money, and they were looking for a fund manager, actually a fund of funds manager, because the idea is to help support those local agri-focused funds, say Ugandan, investment fund that's focused on agriculture, that would have a really hard time raising concessional capital because they're not walking the halls at like the World Economic Forum. They're not at New York Climate Week, because they're based in the country just doing the good work. And so this fund of funds is basically looking for those kinds of funds and taking a first loss position to help them then raise additional money. So you're trying to unlock these domestic funds, and it also has a climate resiliency component to it. It also has a technical assistance facility, and so they're very interested in partnering with TA providers and potentially funding TA providers. The fund itself is now managed by INP, Investisseurs and Partenaires, which is the French fund manager group, has a lot of experience with fund of funds, and it's just kind of getting underway. They've not done their first investment, but I know several funds are in kind of final diligence, and we're expecting an announcement soon of their first deal. So yeah, I will park there and hand over to Juan. This kind of high level, plays within the space, and Juan's going to give you some more kind of tangible examples of how Root Capital approaches the space.
Thank you, Dan, and thank you, AMEA and Casey for inviting us and for having this conversation. We're really excited to be here. Could we go to the next slide? And as Dan just mentioned, my purpose here is share how Root Capital is kind of applying this in our day-to-day practice. And I love starting to talk about this by starting to talk about the people who we work with. And so this is John. He's from Betian Nuts in Kenya, and he is leading a field team that's actually showing how to implement climate smart practice in the field. And the key here and to remember is the farmers that Betian and the farmers that our clients work with are usually farmers who have very limited access to technical assistance. 75% of smallholder farmers do not have access to reliable technical assistance. And so the team that John and his team does, the work that John and his team does as other of our clients is really important to share that with them so that they can become adopters of technology, of climate smart technology. Now, doing this technical assistance implies not only showing the practice, but also de-risking the adoption of those practices because those farmers are living in the margins and need help walking that line. Could we go to the next slide? So I'm going to put John in the parking lot for a second and we'll return to him at the end of the presentation, but I want to give you a quick introduction to Root Capital. So Root Capital has been working for over 25 years in providing access to finance and capacity building to the SMEs. Next slide. And the key here in our theory of change is that we're able to identify socially and environmentally responsible agri-SMEs, and then we provide them capital, capacity building, and connection to other partner organizations so that they are the ones that can deliver the change in their communities. They provide stable incomes, they provide mechanisms to adopt regenerative agricultural solutions, and that is what unlocks all the possibilities that we can see as the expected outcomes that we have. Can we go to the next slide? And so for the last 25 years, we've disbursed over $2 billion for more than 843 businesses around the world and helping or reaching more than 2.3 million people. And this is why we think it's really important. And in my job at Root Capital, could we go to the next slide? My responsibility is managing our impact data and our impact monitoring and evaluation team that handles our data. And so next slide, please. We use monitoring as many of you probably use impact monitoring data. We use it for impact reporting, and it's really important for that purpose, right? We believe in holding ourselves accountable and sharing with our investors and donors of the type of impact that we have. And so we have a set of KPIs that most of you probably have and most of you probably see. Now, we use data in a more creative way. And could we go to the next slide? Because we are just not thinking about impact monitoring as reporting. We actually set up our ESG due diligence system through our monitoring data, and that way we are actually assessing that enterprises have the positive impact that we believe they have in the world. And then we can also use that data that we collect to actually inform programmatic decisions for the organization. And in the next slide, I'm going to talk to you about one way in which we do this. And again, I'm walking through a lot of this content quite quickly. You'll have the presentation after if you want to go into the details of all that I'm showing. But the key is, for instance, we have developed an EDI, which is the Enterprise Development Indicator. And this is a tool from our monitoring data that allows us to characterize, to know and share how our clients look. And based on the next slide. And this allows us to do very interesting things because we are actually supporting operational decision making by that data. And so with the EDI and by looking at the characteristics of our clients, we can actually segment our portfolio and be intentional on how we are reaching the clients and meeting their needs where they are. We can also have a guidance framework to understand which of the different clients are eligible to receive what services that actually match their needs. And we can change our monitoring and impact goals based on those developmental categories of our clients. And so we are being intentional in the use of our data to inform our programmatic decision making and actually like working with our clients as partners, meeting them where they're needing. But this also allows us to track their development, to see how our portfolio is being aggregated globally or regionally, and it also contributes to our field building effort. Next slide. So I'm not going to bore you with the details. We have a report coming out of how we do the EDI, all the indicators, but the easy way to understand this is an indicator that comprises 6 components or dimensions that allows us to understand a business or a client in its context. And so you can see here the dimensions, and that allows us to think about, well, maybe this client is having a low number in the financial capacity. And so our technical assistance should be targeted towards helping them improve that characteristics. Or maybe the issue has to do with their ESG strength. And then maybe we have to think about tailoring our services to address those needs. The next slide, please. And again, this is a complex indicator that has over 25 indicators within it. We know and do not expect all of our peers to do this, and this is the way that works for us. But hopefully you can see that by having different understanding of our clients and by using your data more strategically, you can actually leverage to make programmatic decisions. The next slide. And so once you have an indicator that allows you to break your clients on their characteristics, you can start being really intentional in the targeting of our clients. And so, for instance, within the 5 categories that we have, we can see the average and means and median sales of each of the client and know maybe, well, based on those annual sales, what are the type of products that we can think that actually meet their needs? What are the type of lines of credits that they should be looking for? What is the type of risk that they might be able to manage? Next slide. And again, so we break this portfolio, our portfolio of clients, into 2 segments. And so categories 1, 2, and 3, based on the EDI index, are clients that are designated in the accelerator portfolio. These are the more developing, the earlier stage clients that probably need more help of technical assistance to improve their business capacity, to improve their accounting mechanisms, to improve their harvest managements. They are on the earlier stage and they are just growing. And so we're helping them formalize so that they can access the different lines of credit. Usually for clients in this category of the accelerator portfolio, Root Capital is the only lender that they have access to. But the idea is that eventually they move to a growth portfolio where they have access to different sources of finance, where we are serving them with technical assistance that is more sophisticated, like our ACRA services or our digital business intelligence services that allows them to utilize digital technology to improve their accounting, their data, and their reporting. Next slide. And so finally, we also use our impact data to understand our impact. And while we have a whole set of the team that is doing rigorous impact evaluation that use econometric analysis to truly isolate our impact, we also use our monitoring data to see the impact that we're causing in the world. And I want to point here to something that Dan had mentioned about like the importance of like partnering and sharing in catalytic capital. For instance, if Root Capital was going to report its impact data alone, well, we closed last year over $128 million in loans. But we believe that where we are really contributing and helping change the system and the way that we can contribute in spaces like these and with peers like you is that we look at other sources of finance that were unlocked for our clients. And when we do that, when we look at those other sources of finance, we see that actually Root Capital unlocked over $250 million in financing to adopt the climate-smart agricultural practices that we know have an impact in the world. Next slide, please. And so this is an opportunity to talk about our region framework. And so this is something we are extremely excited about, which, as I'm sure all of you know, there's different frameworks out in the world that talk about the adoption of region agriculture. But a lot of those frameworks that are still at a high level and trying to see how you actually measure that in the ground and classify a client to know if they're adopters of a region ag practices, it's a little bit more nuanced and complicated. So we came up with our solution, which is again our solution that we're willing to share, and we're wanting to start this conversation just to ensure that we start moving towards some standardization of how we understand region. Next slide, please. And so, again, why do we care about this? Well, given that there are multiple frameworks out there, we could make claims about 98% of our lending portfolio being or implementing at least one regenerative agricultural practices. But that is not that useful if we do not have a standardized measurable framework that allows us to understand where in the space of regen ag our clients are. Some might be just starting in that transition, others might be adopters of some of the early practices, and others are regen agricultural leaders who are actually like very advanced. And Batian is, for instance, a good example of that. Next slide. And so we went to the painful exercise of mapping all type of indicators and trying to do all the desk research to think what are the set of indicators that actually we could be measuring today, either through our data or with very little tweaks to the way we collect our data to actually identify what makes a client an adopter of regen agricultural practices. Next slide. And I'm available if you want to ask about all the different practices that we're looking, but at the core, we ended up with a regen data collection tool that allows us to see from four pillars of regen agriculture, the number of core practices that the client is adopting. And based on those core practices, we can actually give a score that help us analyze if the client is an adopter of regen agricultural practices in a way that we can communicate to our donors the importance of that client being a leader in the field of and in the space of the adoption of this climate smart technology. Next slide. So before I finish, let's move back to John and remember about John. And so John and his team are implementing partnerships that we are doing with Regen Organics, which is providing Regen Organics is a company based out of Kenya that has organic fertilizer. And what we're doing is we're helping John and his team show a field demonstration so that farmers can see the benefits of adopting this. And we're providing finance so that not only to fund this field test, but so that farmers actually can see the positive impact that adopting this climate smart practice can bring to their realities. And we believe that if we continue to work towards crowding others and convincing others that investing in businesses like Batian is essential to drive the regen and climate outcomes, we can actually help move the needle towards that goal. So I'm going to leave it there to leave a lot of space, but please do not hesitate to reach out, and we're always happy to have this type of conversations. Thank you.
Yeah, no, thank you both very much. Thanks, Juan. Thanks, Dan. At this stage, with the 30 minutes we have left, we're going to pivot to sort of more of just a general discussion on what was presented, answer any questions that are coming through in the chat. I think there's a good place to start. We also have a few questions pre-prepared that we were just going to discuss through as well to kind of get some more detail around what was just presented by Dan and Juan. But I think if you guys don't mind, maybe Dan, there's a question that came through from Jasmine in the chat. And it seems it could be more of a clarification on technical assistance potentially. But the question is, what is the mechanism within blended finance, within climate finance, that benefits farmers and farm organizations, given that they are struggling? So probably leaning into some of the conversation around access to credit and capacity building and technical assistance, but maybe you can highlight a bit more there, Dan, in answering that question to kick us off.
Sure, yeah. I mean, it obviously depends. But at the end of the day, finance is just a tool, and blended finance is a tool to try and unlock more financing. But it's the it's the businesses and the the NGOs, BDS providers on the front end who like support the farmers, right? And then benefit the farmers. So there's different tools. I mean, technical assistance, most obviously, if you can get, as we know, it's hard to get that grant money. And so I think that's why there's been a lot of interesting work by AMEA and others to look at how do you make BDS providers not just dependent on TA, but have other sources, whether it's the businesses themselves or the investors or others paying for a portion of that. So I think that's like an interesting channel. In terms of like the investment money that's actually in the capital stack, I mean, typically that addresses one of three things. Like you're either addressing risk, because the banks aren't lending because it's just perceived as too risky or is too risky, and so you can do like guarantees or other first loss capital to try and actually reduce the risk. Secondly, it could be addressing liquidity. So particularly for some smaller organizations, I mean, Root over the years has built up its capital, but someone had to provide them capital in the first place, right? And there's particularly these like ag techs, fintechs, and more nascent organizations, they often need liquidity, and that's part of what the FASA fund addresses. Is that domestic fund managers, it can take them a long time to raise that first round of money, and so FASA being there gives them a place to look for that to get started. And then the third thing it addresses is cost of capital, and this is kind of there's always debate about whether you should be offering capital below the market rates, and I know it's something Root has thought about too, because they typically come in at at equivalent market rates in order not to undermine the domestic financial system. But on the other hand, you're trying to create incentives for farmers to adopt regenerative or resilient practices. There's some exploration now of like, well, maybe you should actually do concessional loans to incentivize farmers to adopt regenerative practices. So I think there's a lot of different levers you can use in blended finance, but at the end of the day, it's a tool. It's the front end companies and BDS providers that support the farmers.
Yeah, thanks, Dan. Juan, did you want to add anything else?
No, I think like just as Dan just pointed out, the key there is this is just a tool, and the reality is that, for instance, what we are seeing in the field, like with climate action loans, is that for instance, the appetite to this type of financial product has to be reassessed to understand that maybe in a context of a climate smart agricultural investment that might have a longer return, well, some of that blended finance can help to alleviate the time to see that return. Or there's different mechanisms, and again, this is just one of different tools to understand how to make this actually meet the needs of the climate of the clients and the organizations. And so the technical assistance should be geared towards looking at what those needs are and kind of helping those organizations to address them.
Yeah, those are all great points. I mean, this is part of the ultimate challenge we're trying to unpack here, like you've noted a few times, Juan. And it comes through pretty clearly in the ISF Advisor, play four, Dan. Just thinking about technical assistance, it's affordability, it's accessibility, it's the segmentation and what the segment it's tailored to, the categories of businesses you were working with, Juan, in your presentation slide. I think the Agri-SME Learning Collective and the work that entity and network has done in terms of pushing forward clear segmentation boundaries that could be adopted as industry standards to help with tailored technical assistance. I think one thing that would be helpful, as I've become over the last couple of years from the Nuru perspective, getting more and more versed in blended finance and these approaches, has really been, what are the pathways to access those technical assistance grants to support a network of agribusinesses, in Nuru's case, smallholder cooperatives, that are really at the early stage of those categories, nascency, category 1, 2, where as Root Capital provided, but the early, the transitioning to an intermediate level if we're using the Agri-SME Learning Collective segmentation framework as well. And then there is this need, as you noted, Dan, to think about technical assistance in terms of, where should it be something that's just paid for, or is it a public good to some degree, right? Because extension itself, agricultural extension, has been somewhat defunded since the 80s around the world. As you mentioned, Juan, right? 75%, I think, was the number of smallholder farmers was that the number used at the outset, I think. And so we have to have that conversation within the context of blended finance, I think, is really important. So just a few thoughts on that kind of opening question. You guys already sort of addressed the first discussion point here, and then the question from Jasmine, I hope that answers it for her. But but I think something else, if I'm seeing what's coming through the chat, I wanted to just touch on, before we get back to those questions, this alignment around business. You mentioned it, Dan, a few times, and then it comes through in the EDI in particular, Juan. What can be, and then what technical assistance facilities are really targeting in terms of capacity building or development, right? In many cases, it's the adoption of CSA or the adoption of regenerative or agroforestry or a sustainable land management, if it's rangeland and grasslands, for example, in Brazil or wherever in the world it is where technical assistance is being provided. And then the BDS side for the agri-SMEs, which is a key element of it as well. We've talked about this a little bit together previously as we were preparing. I thought maybe you guys could share a few additional thoughts on where there's overlap in those Venn diagrams, where there's not, where collaboration can practically be applied within technical assistance within a given landscape, as you noted, Dan. Do you guys have some thoughts on that just to tease out before we dive into some specific questions in the chat?
I think something we emphasize in the report is just make sure you're starting out with looking at what the government, the government and local and national government are trying to do, because you're going to be much more effective to piggyback on that, and then try and build a program that's supportive of it. And I think these landscape-based projects are interesting, or the way Anne Green approaches it, where it's like there's kind of a shared vision. It's not just coming in and saying, well, I'm going to do this program over here, but actually trying to piggyback on the momentum, where the public money is going. Because it's the funding for TA. I mean, it's constrained, right? I mean, there's a question here about what proportion of TA should be, what should the proportion of TA be relative to the investment? And there's kind of this rule of thumb of 10%, if you raise a fund of 100 million, then you do 10% TA. We did a whole analysis of benchmark a bunch of these funds, and they always say, well, that's never enough. It's kind of the rule of thumb, but the rule of thumb is not right. It's too little. And the other thing is that investment money recycles, but TA, it's grants. So you spend it and it's gone. The 100 million continues to recycle and the 10 million is gone. So, but there are some interesting things out there. I mean, the Green Climate Funds put a lot of money out there. There's Rwanda has the IREM Invest, which is a really interesting kind of publicly sponsored. It's publicly sponsored by the Rwandan government, but also a Green Climate Fund and EFAD and others are in there. And it's this blend of public and private money. So you're trying to, meld those together in a smart way. I like what what Gawa Capital does, the Huruma Fund, where they actually recycle a small portion of their financial returns, but a portion of their financial returns go into replenishing the TA facility, so that it's not, you don't lose it. I mean, it's hard to do that because we're big margins as it is. But at least there's a mechanism there to regenerate some of that TA funding. So yeah, it's a tough question, but there are some interesting models out there.
I also think that, again, I agree with everything you've just said, Dan, and understanding where you can find complementarities is always interesting. Also, another reality we should not forget is that there's other providers of technical assistance that might have different types of interests. And we have to be very careful when we are being transparent of taking them into account. And so, for instance, sometimes it's agro-processors who have the interest of providing the technical assistance. Even another great source of technical assistance, for instance, in the space of coffee, might be certifiers. There's different places and different spaces. And what I do think, Casey, back to your question, is the complementarity of the traditional agronomic technical assistance that we're used to with the BDS is where we see a lot of potential. Because again, many times, even thinking about how you are structuring the provision of the service, it's already a business decision that many of these agri-SMEs do not actually have. It's a funding capacity question. It's a capacity how many are you actually going to reach? How frequent are you going to reach them? Through which means? And that is always a question that we have to think about. And so probably at the more nascent stages, we see the first entrance for the technical assistance that we provide actually more focused on the business development, because that's where we see that it can have more it can provide more catalytic functions around, if we want to use that word, or it can unlock more opportunities so that eventually they can start adopting different types of or traditional technical assistance when they have the capacity to fund this. But it's always a really hard question. In our particular case, we provide the technical assistance because we know the returns that it provides, so that eventually those clients come into our portfolio and become part of our lending pipeline. And that's why we are providing these resources, because we believe that in providing those resources, we are helping those clients to get to more levels of sophistication, to get more stable in their business practices, and to grow. And by growing is that we are actually like allowing them to be part of our pipeline and eventually exiting our portfolio.
Yeah, that's a great last point too, Juan. I mean, the fundamental, and that's where from the newer side I'm coming at it because of the nascency and the early stage of the businesses we're working with. BDS playing such an integral role. Yes, we have to work with in cooperative context. You have to work with the farmers, provide value to them, as well as the business leaders who are also part of that farmer group and membership because they're duly elected. And so working with co-ops gives you that approach where you can work simultaneously at both levels very effectively and cost efficiently because you're working through the same groups of people in different roles. But it's really how you sequence and layer over time. And this goes back to the patience having sort of multiple layers to it. There's the patience and the finance to wait for the outcome that they're trying to invest in and the return. And then there's the patience within the de-risking side that also has to be built into the patience and the return. And aligning those two timelines becomes really important from a blended finance return investor perspective of when you can actually expect the outcome based or the financially based return that you want to see. Is where are these businesses now? What types of services do they need? How do we segment them? And what can you expect from a group of them that actually can generate enough value to offer a proper return, whether it's on natural capital or it's on traditional agribusiness value chain related capital and growth. And that's the part for me that's super interesting. I think even from the AMEA side of all this work that AMEA has done for on business development services, aligning best practices, ISO 18716, we can get some alignment there too, but then also find out where those categories map back to the initial kind of foundational de-risking that's needed for technical assistance to work for the outcomes in terms of regen, agroforestry, et cetera. You start to unlock a problem in terms of durability. At least you start to see the picture coming together, right? Because if the agri-SMEs or the cooperatives can have a more of a durable, enabling environment for them, have the capacity to make clear, adaptive management decisions, to shift with new suppliers that are coming in or new climate shocks that might be manifesting, they have the ability then to also maintain the durability of those outcomes through their either membership or their clients themselves, right? Their farmer clients as well. So it's really interesting to start. It's obviously still not it's a nascent idea, but I'm seeing these pieces in the sector start to come together and hearing from both of you with various different perspectives at different levels, at least gives me confidence that there's more to be unpacked there and to dig into. Yeah, I lost track of the questions with sharing some thoughts, but I think we can jump back to the chat a bit. If Guillermo, is there anything we missed that you think is burning from the chat at this point, or we can also jump a little bit?
I could jump in on this point here.
Yeah, go ahead, Dan.
Kind of addresses what Mark wrote here about, Roots portfolio tends to have crops with a price premium. I mean, the Roots naturally going to be a lot of export crops based on the financial product they offer. So it's going to be coffee, cocoa, cashews, that kind of thing. So it does beg the question. Well, yeah. Well, what about maize, and rice and more domestic commodities? And it's similar to Connor's point here around. It's you got these small businesses that are not going to be attractive to foreign investors. It's true. Like if you got a foreign investor, first of all, you got the foreign exchange risk in a lot of countries, and that's like the elephant in the room. So as soon as you're using dollars or euros and you're trading in domestic currency, that makes it very difficult. And then the ticket size, if you're actually talking about small micro SMEs, I mean, it's just very hard. I mean, Juan knows, right? I mean, what's Roots minimum ticket size? It's hard to go below 500,000. So, I mean, you guys push the frontier, but it's that's why Aceli Africa was created, was because they recognized for a lot of these like international lenders, it's they did the whole analysis. They found if you a loan of less than 500 or 200,000, like they basically lose money and have to cross subsidize. Local banks can do it more efficiently, and so that brings me to my point. It was like play number 5, domestic financial system. What can you do to unlock the local financial system? So Aceli Africa is providing incentives basically to push guarantees and basically origination grants to encourage banks to lend to smaller businesses that wouldn't access it otherwise. I've always liked Heifer International's model. They kind of fly under the radar a little bit, but they have like this really cool Heifer Ventures facility where they set aside into a trust like some kind of grant money, but they use it as an investment vehicle, even though it is grant money. And they're kind of looking, they set up a program whenever they're doing stuff in different value chains. They look for what is the angle for finance, and then how can they use their catalytic money in order to try and unlock, and push like local financiers or maybe the Inter-America Development Bank. They worked with IDB Invest, for example, and like co-invested in some things. So they're trying to use their money in order to like as leverage points to try and unlock the local financial system. So I guess the short answer is like you got to look for local capital, because otherwise you're dealing with the FX risk, and that just kind of kills the model.
But if I may jump over here, a couple of things. I think like what you were saying over there of the importance of local capital, like we have the anecdotal stories, but one of the ways in which we are able to unlock those sources of finances is how after going through a root capital loan, clients are better prepared to face those local banks regulations or the requirements of documentation that some of those local banks are, because we have helped them develop those capacity that the local banks usually do not have the time or the capacity or the resources to provide that. And that's a way in which you're unlocking those other sources of finance. We have ex- externally with similar models within the country, but that requires a lot of knowledge about the key actors within the field. And again, we are starting early piloting and testing, and this is an important thing. I think a key takeaway that I invite people in this call is you have to be willing to be a learning organization and pilot some of those local value chains. It might work, it might not work. Probably we are in a lucky space where we have the opportunity of going doing those type of piloting, risking the loss that if the pilot doesn't go well. But we need to be creative in the way that we are approaching these financial gaps in those local contexts. Because if we are trying to just copy and paste a model that was used elsewhere, or trying to just use the same tools that we were expected to be using, like for instance in international markets, we're going to fall short on that.
Yeah, I think there's a few things there. One, you both noted, technical assistance playing a role in helping to unlock local finance, national level finance. That's what you just described, Juan, in terms of Root's work to build up that capacity, but also then probably communicate the value or how to properly communicate and align with due diligence processes within local banks and portfolio managers to actually feel confident that they can make that investment. There's that aspect of it, certainly, and what that role looks like going forward. I think one is, again, and then how do you sustain technical assistance? Where does it get embedded into the businesses themselves, right, in their own business model? Yeah, those are all really important points. I mean, and I think that is, Dan, to the bigger picture point, why blended finance is an interesting opportunity to pair those types of finance together to help mitigate various risk aversions, especially around FX for international investors. The other side that's interesting on the short value chains is, I mean, some of these landscapes where maize is produced, soy is produced, groundnuts are produced, semi-arid, somewhat, lower rainfall capacity, unimodal systems. There's also, like Dan said, I mean, cashews, mangoes, other export quality tree crops can be promoted. So thinking about the production systems, regen ag, and how that can be aligned with expectations and outcomes, communicating that through proper TA, and then the timelines necessary and the patience necessary to see, those trees grow and come to yield, essentially, is a really important part of this conversation. So it's like TA is multifaceted and collaborative. And I think that gets lost sometimes in the conversation of, like, we just talk about technical assistance as if it's a catch-all, but it's really much more dynamic than that, as you guys have both noted. I know Nuru, from our experience, we've seen that as well. For example, similarly with the work we've done in Ethiopia, helping cooperative unions access finance from local and regional banks. That's been a really key feature of leveraging things like Scope Insight Assessments, which is a partner in the Netherlands, who does, standard capacity assessments around 8 dimensions. Not terribly different than the EDI, but not quite as rigorous on the quant side. And so it's interesting to think about where there can be shared lessons in terms of how those methodologies actually have been used to influence local finance, to bring it back to that point. And those case studies could be really valuable to unpack further. Yeah, just a few thoughts from just responding to what you guys were sharing. And some of the questions in the chat. I think there were some good questions too, and kind of comments. I saw yours, Lawrence, on the Global Flagship Initiative for Food Security. Yeah, I have been monitoring that both at Nuru, and I know many others have. There is some interesting discussion there around agri-SMEs, and standard metrics and getting beyond basic profitability. I don't know we're not actively working with them. I don't know if Dan or Juan are from their perspectives, but certainly something to monitor there, that recent flagship event or initiative that was launched at New York City Climate Week, I believe, this past year. And go ahead, Juan.
I think a key there is at least we are seeing multiple spaces, like we have the Learning Collective, the Agri-SME Learning Collective as one, but the Global Impact Investment Network also has a space. And there's different calls for standardization, for defragmentation of this data. But I think like the reality is that we need to be more transparent on the usage of data and the sharing of data, and try to, like, again, rethink how we are talking about data, because the reality is that our clients, those agri-SMEs, usually are facing the same requests that are similar enough but different. And so the burden of collecting all this data from all these different institutions that are providing them assistance is just like extremely burdensome. So again, I clearly do not have the one answer, but to continue this conversation and try to make a move so that in each of these different fora that we meet, we start pushing, like, how about if we are trying to get some of these spaces together? We probably won't reach with an ideal set, and probably will have like just a framework, but that already will be a lot, right? If we could agree and start a framework and develop it jointly, that would be incredible.
Yeah, no, I'm sure Dan has perspectives on data sharing and trying to collect that too. But yeah, transparency and overall data sharing around these networks of agribusinesses across various countries. I know that's an important area of emphasis for AMEA that came through in the convening for the membership. I know it's also really important for the broader sector. I think how that gets packaged up and utilized is often the challenge. Some of it can be used for competitive advantage to some degree, especially from an investor perspective. So how we do that in a way that really meets the needs of multiple layers or multiple levels, national and international investors, is something that's interesting to discuss further. I mean, ultimately, yeah, it's how do we get more money into the hands of farmers to help them transition to these more climate smart practices, to insulate them from those risks. And if we need to build more confidence and trust in those agri-SMEs as an intermediary, I think that's a really good direction to kind of take the conversation, especially with some of these questions around MSMEs and smaller businesses, co-ops, so on. One piece I always fall back on for cooperative work and cooperative development work is, the seventh principle from the ICA, the International Cooperative Alliance, which is cooperation amongst cooperatives, right? Their ability to pool their potential value across a landscape of farmers and pastoralists or whatever it may be in that given landscape is something that it gives them some leverage, but also can help gain cost efficiency in terms of TA provision, sustained TA provision, and other things. So just another idea on the co-op side that I think lends itself quite well to this conversation. But I'll give you guys a chance, Juan and Dan, to do any closing thoughts in the last 4 minutes here before we stop the recording for the second time. I think we had a technical difficulty, but I'm sure we'll get it all together at the end. So Dan and Juan, anything else you wanted to share with the audience before we close out?
I guess just on the point about standardization is hard. I think about, like, same as there's like public money and private money. I also think about sort of public data and private data. There's like data that's data is like the new currency, right? So, but it's so hard to manage, especially for like public access, and to verify that it's true. But I think the starting point is, first of all, figuring out what we want to measure. I remember when we first started started CSAF, the Council on Small Direct Finance, right? It's like Juan knows, and we helped do the standardization of the metrics for all of the 10 lenders that were part of it. And the first year, they're all measuring different things. And then we realized even when they were measuring the same thing, their process to measure was differently. So one said 1,000 farmers, one said 10,000 farmers for the same co-op. And we're like, how is that possible? So it takes a long time, but it starts with like agreeing on what we're going to measure and agreeing how we're going to measure, and then figuring out where you put it together. And it is great to see what AMEA has done in terms of, I mean, you have an ISO standard, and so I applaud that effort to just get people kind of aligned around, common metrics. And there's so many communities out there trying to do that, but it's a journey.
Yeah, and for me, like the recognition that it is a journey is the key part of it. Like we are working on a problem that is just like one of the most challenging problems that we are probably like facing. And for the communities that we are serving, it's really important that we kind of try to do it well, but know also that it will take time. And perhaps just leave. I really want to thank you, Casey and Amaya, for inviting us to have this conversation, because I do think these conversations are valuable, so that we at least can have the opportunity to share the different insights from our experience. From our perspective, this is the way that we are trying to crack this nut. We haven't cracked it completely, and we're always willing and inviting others to be critical and to walk this journey with us, because that's the way that we are actually making it better for those communities, which is what matters at the end.
Well, yeah, thank you both for your time, and thanks everyone else for joining us. We will continue the dialogue series from the Environmental Working Group at AMEA going forward in the next year. So you'll see another announcement come out probably in the first quarter, January, February. We'd like to continue this conversation also, because what keeps coming up even in the Environmental Working Group and through these conversations, like Dan and Juan just said, is data sharing, data standardization. And I like the way you framed it at the end, Dan, is private and public data and how we look at that for the purposes of driving more money to farmers and agribusinesses in these places. So thank you all very much. Have a good rest of your Wednesday, and see you around.
Bye, everybody.
Thank you very much, Dan. Thank you, Casey. Thank you, Juan.